Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining me is Phil Mackintosh, Chief Economist at Nasdaq, for an update on the latest COVID-19 news, the U.S. and global economies, and how markets are digesting the progress of reopening the economy. And Phil, it looks like the markets will be turning to politics as the Democrats' four-day virtual convention kicks off today.
Yeah, I think that's going to be the focus, especially from the newsreel point of view. But it's interesting because even last week, we really didn't see that much movement in the markets. We had, a little bit of a rally Monday and then a pullback Tuesday on news that the stimulus might be on, and then the talks had stalled. And we now know that the talks did stall and the Senate's gone out for the summer. But even though that happened, we didn't actually see much more volatility in the market. So I have a feeling the news cycle, it's the middle of summer now. You can see the intraday volatility starting to slow down, even though volumes have been a little bit elevated. We'll probably be talking more about politics this week than anything else.
Yeah, it's going to be an interesting 80 some odd days of politics and the impact on the market. So let's get an update on COVID-19 cases approaching that 22 million mark.
Yeah, but there's some good news in the COVID data. If you look at it sort of longer term, we've got a downturn and definitely a slowing of growth coming out of Latin America. You've got a clear downturn in the US cases now. So all of those renewed shutdowns that we talked about weeks ago in the South and the West are definitely having an impact on the US cases. There's a few upticks coming through. India still has cases climbing. And there's, the rest of the developed world is looking like they're having a bit of a second wave, but it's really isolated, mostly in Spain, a little bit in Japan, a little bit in Australia, but most of the actual caseload that's coming out of that dark blue line is Spain. So I guess the lessons from this is we've learned how to get it under control. We know that it works. In the US, we've still got a long way to go to get back down to comfortable levels to get back out and do things more broadly. But it also shows that it's still pretty contagious. In Spain, with all of the people going there for holidays, they seem to have had a spike in a couple of different locations. So we can't really stop being careful, that's for sure.
Yeah, it'll be interesting to see how this plays out. Even in the U.S., the last couple of weeks of August and even the first week of September, people holiday as well. But some more encouraging news, unemployment data below the 1 million mark.
Yeah, and that was some good news last week as well that didn't seem to move the markets much, but you can see that the unemployment or the new claims for unemployment has been trending down, which is a sign that people are getting back to work, whether they're 100% employed or not. Isn't so clear from the data, but definitely companies are starting back up, production starting back up, retail spending actually has been pretty good and is pretty much back to normal. But what's interesting with the production, like the industrial side, is it's really being held back by mining and oil and aerospace, so three industries that are really affected by people demanding less and traveling less. Obviously in aerospace, combined with the lack of travel, you've got the 737 issues as well. So those sectors have dragged down production, but even without that, production itself it's stayed 8.4% below pre-COVID levels, but it hasn't been hiring at the rate that it's actually been seeing increase in production. So it's been holding back employment a little bit. Really, where I think that the gains are coming from is in retail. It's in restaurants where people are starting to go back to restaurants, and that sector we know is a big employer. And so the data last week actually showed that the retail sector is now back above pre-pandemic levels. That fits with the inflation data we talked about last week, where at inflation coming back into some of those traditional categories of oil, vehicle prices, plane tickets, clothes, appliances, and things like meat and other groceries getting cheaper. But what's interesting when you look in detail at this retail sales data is the non-store retail is above average. So the online retail is doing well, but the in-store retail is actually still 10% below normal. So even though we've got retail spending back to pretty much normal levels, where it's being spent is still different.
Yeah, that's a good point. And so speaking of lower intraday market volatility, I just want to touch on that again. And there also being a stalemate with stimulus checks not, recirculating as it stands right now. It's still just surprising to me how stocks have been, most sectors anyway, have been trading so well when, you have tens of millions of Americans out of work, and most likely a lot of those, they won't have those jobs to come back to. I mean, GDP is so reliant on consumer spend, and that's what the stimulus checks help to prop up. So, the piper has to be paid at some point.
Yeah, so we've talked in the past about how big the stimulus checks really are as a percentage of GDP. And I think the US is actually leading in that category with well over 10% of GDP coming through the stimulus. Last week, we separately did a study looking at retail trading, and there's a fair bit of evidence that it's pretty elevated on the markets at the moment. So potentially some of those stimulus checks are making their way into the market, and that would contribute net buying as well. It might be enough that that's supporting the market, but also we've got the factors of potential inflation. And if we're going to have reasonable inflation, we've had a huge increase in money supply. When we have an increase in growth, that money supply will start to trade faster. And typical economic analysis says that's going to cause inflation. People are starting to buy the TIPS ETFs. They're starting to make some bets on inflation in different spaces. Obviously, the gold and silver rally that we've been talking about is potentially an inflation play as well. So I think when you've got potential inflation on the horizon, stocks are a relatively good place to be as well compared to bonds, which are obviously stuck at par and are only going to pay back the $100 that you bought them for.
All right, Phil, thanks for joining us as always on Trade Talks.
You're welcome, Jill.
And thanks for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.